All right. Well, since last week was a lot going on, I figured it was a good chance to respond to what appears to be again a growing recession fear call. Whether it's in Twitter, whether it's in my inbox, whether it's talking to people, people are now becoming more and more convinced, which is normal, that there's a recession. And one of the reasons is whenever stocks now go down, people tend to jump into the recession camp. So I wanted to accomplish a couple things today just because, number one, as I've said, I don't think we're going into a recession. Number two, back in August, when I did my first kind of YouTube video, I did mention that we're in a regime shift, and I think it's now more clear than ever what the regime shift is. And again, the difference between a recession and a regime shift really has to do with number one, the Fed will be cutting rates. That's a given now going forward. We don't know how much, but as I go through some of these charts, it's starting to lean more and more that it'll be more than probably what we expect in the short term, meaning I'd say over the next 6 to 9 months. But that'll be going in the face of very clear evidence that the economy is slowing, and based on traditional measures, now with the payroll market joining what had been all of the things I've shown in the past, LEI, IP, ISM, go through the litany of indicators that have been very successful during the Industrial Revolution to predict recessions. It has every economist my age and above using that data to say there's a recession happening, and most economists on Wall Street are raising their estimates. So I'm going to burn through these fairly quickly and just kind of show you what's going on, and I'll finish it with why a recession is much tougher, and just make sure that you guys can see some other charts that will make that clear. So let's just burn through what happened last week. This is the S&P. It was the worst week. It was down 4.25%. Worst week since during SVB. For the month now, we're down 4.25 because that just started it. Just to put it into context, not only of where we are, which is this is really nothing, especially over the last 4 years in terms of so far, but it also, again, just shows, which people forget, when we had the weakness that occurred, all we've really done now is given back what had happened from a positive basis in July and August. Despite all the fears, the VIX had its biggest weekly move since 22. So we definitely had a scramble for people looking for hedges. I would say this has more to do with the fact that we came out of the summertime at all-time highs, and we started this week off with people quickly being worried. What has driven it again, and what's most important, is the NDX. Now, the NDX, I brought this up just because this is the ChatGPT breakout above the 200-day moving average. White line is the 200-day moving average. Held it in here, closing back above each time, stayed above here, kind of went down here, looked at it, went down during the August fall, and now we're approaching it again. I still believe this will be the critical thing to watch, and obviously what's been driving it has been NVIDIA. And so the AI bubble, as I've said, I think it's peaked. And when I say bubble, I just mean the you can buy anything with enthusiasm because of NVIDIA has finally reached an inflection point. I think that is a certainty now. They have to blow away numbers. Just beating numbers is not enough. It gets rid of the enthusiasm. And you have more and more people on the mantra of when are the revenues going to start coming through. And my belief on AI is, number one, it's going to make it feel constantly like it's a recession. This is about efficiency and productivity. There's very few companies that are going to see big impacts, but where you will see it is where you've been seeing it for the last 40 years of technology, which is in profit margins, which makes recessions harder to have. So when you're thinking about AI, I've actually started to hear people start fading what's going to happen in AI. There's going to be an enormous amount of things which will change our lives next year and in the coming 3 years that I think it would be foolish to sit there and fade AI and believe that we've reached the peak of it. So I'm not going to spend a lot of time on that now, but I will do something in the future. So this is the 6 month or the 126 day rate of change on NVIDIA, and we're almost back to zero, which means it's consolidated. The reason that's important is I think that's what you're going to see in the regime. This is the information technology sector relative to the S&P since the beginning of the iPhone. And I think people, again, forget how much the world has changed since the iPhone came into existence, how many jobs have changed. I'm going to go through some of that. But more importantly, when tech starts to underperform the S&P, that is a regime shift. And that's what we have right now. You can see it's unchanged since the beginning of the year, meaning in January. We're currently at the 200-day moving average on this. I wouldn't be surprised if we went down further on this, but I think you're entering a period of support on technology relative to the S&P, but I would expect something along these lines, This was when the peak of kind of I would say the first wave of the software bubble kind of came in and people started fading things. It was doing well during '08 into there, and then we started to go sideways, and really tech versus the S&P was unchanged over a 5-year period. I don't think we're going to do that now because AI is moving faster, and I think the benefits are going to be seen in ways which will allow this to go. But the reality is, as long as tech over the S&P, which is the white line, is moving down, you should expect that the S&P, which is the orange line, is going to have trouble, if for no other reason, just because of the weighting of tech, which is over 30% now of the S&P. Just a few things in terms of factors. There's still a quality versus beta movement that's going in. This is beta over quality relative to the S&P. So beta fell sharply relative to quality, which is something that goes on when people get very scared and the market goes down. We've already taken out the lows. So I wouldn't be surprised if the S&P had some more weakness during the coming week. If not, maybe around triple witching. But this is another way to look at it. This is pure beta versus pure profitability. So I use the Bloomberg pure factors to strip out the sector bias towards it. And in this case, the reason I bring this back, this has been going on for some time. And the reason that you've got this beta versus quality rotation that has been happening, meaning you can see that beta, quality's been outperforming beta. So beta's been under pressure for a while. And the reason is because most of the stuff that fits into beta at this point is matched up with the ISM. And so this is that chart, pure beta versus profitability overlaid with the ISM. So with the ISM going down, it shouldn't be a surprise that you continue to see this. But the divergence that has occurred really since late 23, but I would say started in, for the most part, at the end of 22, which is again when ChatGPT came in, is you've seen the S&P move higher while it's broken away dramatically from pure beta versus profitability. So there's been a profitability move versus beta, and that has people believing that a recession's coming because the stock market to some degree is discounting what the ISM is saying. But again, as time goes on, I think people are just going to have to adjust to the fact that the ISM, which is manufacturing, is a very small portion of our economy now. And so this is another way to look at this pure profitability. This time it's pure profitability over beta. This is just pure profitability, which is another way to look at it. This is it correlated for the last 15 years to credit spreads. And this is the thing I keep saying. We're in a different world. Credit spreads are not blowing out at the same time that people are diving into profitability. And the reason I think people are diving into profitability is because it has to do with margins. It doesn't have to do with other parts of the business. This is a very unique period of time where if you're able to integrate AI into your business, you actually have an advantage here. Data for last week. So I highlighted that the payroll numbers weakened. Well, this is the way that I think everyone should look for the payroll numbers coming out, which is the aggregate payroll numbers, which incorporates the weekly hours, the hourly earnings, and the jobs. And we jump back up after, let's say, 2 months of slightly lower numbers. This puts the quarterly number back to where we had been going. So 3-month average, this is a 1 month. We jumped right back up to where we had been all year and really for the last, say, 2 years. So on that, we wiped out the weakness from the prior month. This is that 3-month average, which is growing, and you can see over time. These are the recessions. This is the great financial crisis. We're still sitting up here growing that at over 1% every 3 months. This is the aggregate payrolls relative to nominal GDP. So people calling for a recession, it just, again, we have a weakening economy. I think it's going to remain weak. And I'm just going to say this now before we get into the final charts after, or the charts which will go through the why recessions are harder than they used to be. I just want to say that one of the things that I think is going to happen, the same way that IP year over year, LEI year over year, the ISM has not meant a recession for the first time really in history. I think we're going to get to a point where you shouldn't be surprised if we're barely creating jobs, if the unemployment rate is sitting without getting better, and we're still not having a recession. And the reason is going to be because of profit margins and profitability. I just think AI, it's going to be a shift from human labor into profit margins, and I think you're going to see that. So this is the 1 month diffusion index, which I say is the most important from my perspective, at least on a real-time indicator, the breadth of the hiring. We're back above 50. We need to be below 50 for a period of time, generally about 3 to 6 months before it gets closer to this. On the wage front, no matter which way you want to look at it, wages had come down. Now the hourly earnings tick back up. This is just showing that it's not just the hourly earnings to look at. This one is the employment cost index in terms of the orange line, still sitting around 4%. And then you have the Atlanta Fed median wage growth, which is at 4.7. All of them are in the 4% range, which means we still have a labor market which shows strength. I saw something this week with a strategist who said claims are a coincidental indicator. They've only led a few times. Whatever people want to do, right now the continuing claims, which is here, people are not losing their jobs and having trouble finding work. And until we see continuing claims trending higher, it's unchanged over the last year. Yes, it did go higher in 22, but I would say that had more to do with trying to convince people to come back to work in the overshoot when we finally got to a more normalized labor market. And that's what's happening, is we're just normalized. This is overlaid again with the unemployment rate. I use this to indicate that the SOM rule is just misleading this time. The service data came out. And again, if you're going to have a recession, we all know you need the service to be in a recession. The ISM service jumped back up sharply, or at least back up to kind of where it was. In terms of the employment component, which was down here, it jumped back up. This is where I'm going to start to get into something that people need to start paying attention to, which is, I've said for a long time, this has really been over the last 6 or 7 years, and I would say it was coming out of 2016, that gas at the pump is not thought of enough as an indicator for when we're going to have a pickup in the economy, or at least real GDP. So the blue line here is the second contract of the unleaded gas future, which broke down to new 4-year lows last week. The red line here is gas at the pump, which not too long ago, meaning before the summer started, was at $3.70-ish. This is implying that we're going to get down to $3. A 70-cent drop in gas is what happened at the end of last year. It happened also in 22 towards the end of the equity market. Whenever you get a large move down in gas, you're obviously going to have a move down in CPI. We're going to see that go. But more importantly, for the bottom 60% in the economy that are living paycheck to paycheck, gas at the pump is important. So if you have a 20% drop off in gas from June to what's going to happen over the next 30 days, unless something changes, it will be meaningful, and you're going to see CPI come down. You also see a little bit of spending shift towards things that are probably get people off the recession call. And this just shows the relationship that has gone on. So the green line here is gas at the pump. The white line here is Fed funds less 2-year rates. Less 2-year rates. So what we have right now is 2-year rates at this point are 185 basis points below the Fed funds rate. So we've had there was recession fears here at the beginning of the year. There were recession fears back here. Whenever you start seeing the move down in 2-year rates relative to Fed funds, saying the Fed is behind the curve, you get these fears. The orange line here is the city surprise index. These things have moved together. So with gas at the pump coming down, if we don't get the recession that people are going, and that's what I want to keep building in here, you're getting an opportunity here to think of the market in a different way. It's going to be more of a trading environment rather than just a Goldilocks environment. It means there'll be more volatility, more ups and downs. I do think the defensives and small caps will probably outperform, as I've been tweeting about. And the reason that we don't, that I think people should be focusing on this as not a recession, I'm just going to go through some charts here. that just highlight it. If you wanted to believe there was a recession, it made sense that in this period here, where we did have 2 quarters of negative GDP, which for a lot of people is the definition of recession, that's when we actually saw a negative year-over-year earnings per share. That was obviously because of the tech stocks. Well, now that things have changed, we're accelerating. Like year-over-year earnings have gone higher, and so we're up to 12% right now. Whether or not we fall back to 6 is irrelevant. You need this to go negative, as you've seen here during recession. So you're betting on there being a drop off in earnings. And here's revenues year over year. So revenues year over year, which are tied to nominal GDP, are up at 6%. So if you believe in the efficiency and productivity of AI and the gains that are coming, that are showing up already for the mega cap tech names, which have the ability of doing this on return on invested capital, as everyone worries about the CapEx, you're dealing with 5.8% revenue gains. Well, if you can do more with less, which is really the theme, then earnings are going to be stickier as profit margins go higher. So you have this scenario where you really need, for a recession, you're calling for revenues to be down year over year. We're currently up 6%, and we're right where we were basically during the periods not, and this is the average, so we're above the average. The reason that this is important, and I start talking about the fact that you can't compare industrial cycle to today, I just want to focus for people to look at this on the sector composition of the S&P. This is from 1985 to 2021. So technology as of 2021 was 27%. It's now 32%. Communication services is now about 9-10%. So when you add these two together, and obviously this is Google, this is Netflix, this is Meta. When you add this with this, you're at 42%. If you take Amazon, and I'll even say Tesla, because Tesla is going to be a major part of the AI movement going forward, and you take their 5-6%, you add it to this, you're now dealing with an economy that is close to 50% technology. When you go back to 2007, you had almost nothing for communication services. Amazon was not part of this. How can you look at technology where it is today, before the iPhone and before software, and even compare it to when energy was double digits of the economy? Now energy is less than 4%, materials are 1%. So you're dealing with a scenario that the economy's completely changed. Healthcare is about 12%. So healthcare plus technology gets you to about 60%, and that's why I always show that there's very little cyclicality in these businesses. So you're really depending that the mega cap tech names will not continue to be able to find efficiency in their business by incorporating AI into their ads, into other places. They may not see a revenue gain, but they're definitely going to see an efficiency gain. And then the financials, based on SVB, the financials are really the government at this point. This is another double digit. The economy, in terms of the way it's measured, is completely different. And you can see that by the revenues. For all the economists calling for a recession, if you just go through here and you see, here's the revenues again, but now you do it, look by sectors. Healthcare, steady as a rock and continuing to grow with about 10%. Technology, 12%. Communication services, 10%. Industrials, close to 0. Consumer discretionary, close to 0. Energy was just negative. Materials, negative. This is why it feels like a recession, because the old economy, the industrial economy, is in a recession, and that's why you have the situation that's gone on with those sectors. And when you use old data, it's garbage in, garbage out. I'll keep saying it on every single one. So leave the recession alone, and I'm just going to finish it up with about 6 charts to go what else has changed. So look at profit margins over time. The real acceleration we saw in profit margins to where we started to really take out the highs was, again, after the iPhone. So here's the iPhone, we bumped higher. Now if you take an average on this, we are so far above. This is the operating profit margin in terms of the red line. And then the blue line here is measuring it from a GDP basis. All of these tell the same story. When you break it out, and these charts here are Ed Yardeni charts. They're great. They're free online. I highly recommend using them to just get some details on this. This is the profit margin for the mega cap 8. You are fading the mega cap names in terms of where they are. They're up at over 24% profit margin. If you go through by each sector, you're dealing with very low profit margin for a good portion. This is all run by technology. Here is the mega cap 8. You have the same profit margins you did in 18. So you're seeing an acceleration. And again, this is related to the AI situation, and I think it's only going to accelerate. In terms of the job market and using labor market, This never gets brought up. In fact, when I talk to people of this, they never know the number. 36% of the workforce is now made up of independent workers. Think of this as non 9 to 5 people. This is how the economy has changed too. Every time a DoorDash driver comes to your apartment, just remember that didn't exist in 2006. Every time an Uber driver picks you up, didn't exist in 2006. I'm trying to avoid going back. I'm trying to build my own business based on consulting work on this particular thing as well as crypto. It puts me in kind of the contract. I've shifted out of the civilian workforce in terms of working in a building and moved into this. This is going to be a trend that continues, and I think that people just have to deal with this change that happened. The other change that happened, the last recession that happened from a business cycle perspective, there was no Fed balance sheet. The red line here is the Fed balance sheet, which is still currently at $7.2 trillion. Here's the S&P. So there's two things about this. One is highly likely the Fed will stop QT next year, which will be some form of saying, hey, we're still doing QE, and people may view it that way. They're also cutting rates. The government situation, when you add in the percentage of spending in the economy that is the government, this fiscal dominant side, and the Fed balance sheet, you're up at 50% of the economy right now is the size of the Fed balance sheet in this. And again, before the iPhone, and I keep saying before the iPhone because those are the events that occurred, you've had a big shift. The other thing that's happened is the transfer from the private sector debt, which is going down, to the public sector debt. So here is the federal debt as a percentage of GDP. And again, iPhone here, you got the Fed balance sheet getting stronger, you got the government balance sheet, and we all know that as we get into the entitlement issue is growing and the budgets, this is going to stay up here. So the government has control over the economy in a much bigger way, and they're not going to allow the bottom 60% to go through a serious recession. So if you're calling for a deep recession where people lose their jobs and they can't get them, I just don't see how with all of that that's going on. What this has led to, again, the red line here is the leading economic indicator. So LEI year over year has been negative, and every time that we've seen a fall like this, you can see the recessions, and this is back to the 60s. We've always had a recession. The blue line here is the coincident economic indicators. The coincident is what matters. That is where we are. So if you're forecasting, you can say, yeah, but you could have said this now for a long time because this has been negative for a long time. When you go through the leading economic indicators, the one that doesn't say there's a recession to me is the one you should be following, and this is the leading credit index. So there's certain components that make up the LEI, and some of those are the ISM new orders, it's the yield curve. So a lot of things you've heard about that are negative and saying there's a recession coming, but credit's not going out. And one of the reasons that this is important is it's a different credit environment than it's ever been. I keep talking about this, but just as a reminder of the chart, this is the net interest payments. I assume most people saw this, but how can you have a scenario where the Fed raises rates and historically when that happens, net interest payments go up either because they're taking out more debt or the interest rates are going higher? Well, the Fed raised rates and it completely collapsed. And the reason is because the technology companies have so much cash, the baby boomers have cash. We have locked in interest rates where we're not sensitive on the mortgage side to rates going higher like we were back here. And all of a sudden now you have a scenario that the net interest payments have gone down. So I'll just finish it with this. This is why the coincident indicator matters. This is, well, I can't see the whole thing. That'll get it in. Coincident indicators relative to the S&P. So when you're looking for anything right now, just remember, I don't think we're going into a recession. I think you should be looking at this regime shift in a completely different perspective. And what it means to me is a lot more back and forth. Don't get over your skis. I don't think the AI thing is going to be a major thing, but I do think there are very big announcements in AI that are going to happen next year that are going to get people optimistic on it again. But I don't think you're going to see the revenue gains. I think this is going to be a profit margin, which means under the bottom of the market, there's probably a bid that shows up. And so with the S&P, look for the lows from August as support, and in the NASDAQ, we're getting closer to the 200-day moving average. That's it for me right now, and I'll check in whenever there's something big going on. Bye.